Okay, hello everyone. Okay, so good afternoon to you guys, or good morning, wherever you're from, right? So just before I start, can you guys hear me clearly and can you see my screen? Okay, so for today, we're going through finding the right strategy, right? And are you a swing trader? So for today, we'll mainly be going through swing trading. Right, just before I start, can you guys hear me clearly and can you see my screen? If you can you please just type yes under the questions tab? Okay, thank you, Jim. Okay, so hi to all of you guys, right? Okay, hello to you. Thanks, David. Thanks, Roger. Okay, great. Okay, it's good to know that everything's all right. Okay, so let's start, right? So for today, I'll be covering on swing trading. Okay, hello to you, Clement. Okay, and thank you. Okay, so this is basically what we'll be going through for today, right? Just before I start, right? Just a gauge, okay? So for those of the people in the audience over here, right? Do you guys trade? If you guys trade FX, right? Are you more of a swing trader? So how many of you guys here who trade, right? You actually do more swing trading as compared to day trading. Okay, so if you do, right, same thing, right, do pop your questions or rather pop your response under the questions tab, right? I want to try as much as possible to keep this session interactive. Okay, great, Jane, you do, right? Same as me as well. Okay, so swing trading, it's the main one, both for you, Roger. So I'm guessing it's swing trading and day trading. Do we have any scalpers here? So there was a period of time that I do more scalping and then afterwards I switch more towards swing trading just because it is less time intensive for me. Okay. Scalper, Clement, okay. Okay, so yeah, so we have a mix of it, right? A pretty good range, right, of both scalper, swing trading, day traders. Okay. Okay, so for today, right, I'll be covering mainly on swing trading. Okay, so as much as possible along the way, right, if you guys have any questions at all, don't hesitate to put them under the questions tab. Okay, I hope to keep this session as interactive as possible. Okay, and also, right, just one more thing, I want to highlight one more thing before I start this. Okay, let me just bring up this. Okay, so just before we start, right? So for this, right? So this is basically the FP Markets webinar website. Okay, so for those of you guys who just stream in, right? So essentially over here, right, you can see that this is a schedule that we have for the upcoming webinars. Okay, so the next one is on 4th of May, right? Candlestick patterns, incorporating them. So we have a list of them coming up. You can apply for them here. Okay, and this is also a background, right? So just a brief introduction of myself. I'm Lee Sing. You can find me here. Okay, so hold on, let me just share this. Okay, yeah, so basically I specialize more in technical analysis, right? At the same time, also other asset classes. Okay, so it can be from FX as well as equities. Okay, so let's start, right? So for today, I'll be covering mainly on swing trading. Okay. Okay, so just before I start, right, the information, so just a disclaimer over here, right? So the information contained in this material, it's intended for general advice only. It does not take into account your investment objectives, financial situations, or particular needs. FP Markets has made every effort to ensure the accuracy of the information as at the date of publication. FP Markets does not give any warranty or representation as to the accuracy, reliability, or completeness of the information contained in this material. Examples included in this material are for illustrative purposes only. To the extent permitted by the law, FP Markets and its employees shall not be liable for any loss or damage arising in any way, including by way of negligence, from or in connection with any information provided in or omitted from this material. Features of the FP Market products include applicable fees and charges and are outlined in the product disclosure statements available from FP Markets website. Okay, so without further ado, right, so this is basically what we will be covering for today, right? This is the agenda on our list. Okay, so I'll be going through roughly, right, for those of you guys who are not familiar with swing trading, roughly what swing trading entails, right? So what are the time frames that we look at? What are the potential strategies, right, that we can apply on swing trading? Okay, and also what is the time that is needed, right? So if you're going to start trading, right, and you want to look at swing trades, for example, what is the amount of time that is needed to be invested in this? Okay, so in this particular style, as well as the time frames for swing trading. Okay, so I'll also be going through a simple swing trading strategy, right, that I personally use myself as well. So that is yeah, some things that I'll be going through, right? So along the way, if you guys have any questions at all, right, please don't hesitate to pop them under the questions tab. I hope to keep this session as interactive as I can, okay? So if you guys have any questions or anything that you like to share in particular, right, because there are some of you guys here who are also swing traders. So if there are any particular strategies that you find extremely useful, right, do share them. If you want to share them, right, please share them down in the questions tab as well, okay? So everyone here gets to learn. Okay, so basically, right, for those of you guys who are completely new to swing trading, right, you might ask what exactly does swing trading entails. So we have different types of trading styles over here. So you can see the one in bold, right? So that is essentially swing trading. So there are four main trading styles that we have, right? The first one is trend trading, or what people call position trading. So this is essentially very long term. Okay, so the time frame that we're looking at could be from yearly to monthly and even weekly. Okay, so for this particular style, it involves usually taking a long term position on a specific. It can be a currency pair, it can even be a stock, right? So essentially, in this case, right, we're looking at the longer term picture. So the charts that people usually look at in this example would be on yearly, monthly, or weekly. Okay, so you can get these charts, right? Personally, I use TradingView a lot. Okay, so you can use TradingView and just toggle between the different time frames. Okay, so for those of you guys who are not familiar with it, I will be hopping onto TradingView later on as well, right? Just to show you guys, right, how we can use this and also combine what we have learned today in terms of using technical analysis, right? So another thing that I use very much as well, it's actually Fibonacci retracements. So basically, how we can use this, right, combine them together and try to find a strategy. Okay, so that's for position trading. In terms of the holding periods, you can see over here, right? So let me just bring this up. So for holding periods that we have, you can see that for position trading, right, it is much larger. So we are looking at between weeks to months. Okay, so this is much bigger, and in terms of the number of trades that we have per week, usually it's between 1 to 2. Okay, so the frequency of these trades are much smaller as compared to, for example, other styles, right, like swing trading, day trading, and even scalping. Okay, so for day trading, right, over here you can see for swing trading, the next one that we have, right, so swing trading is slightly more medium term. The time frames that we're looking at, right, usually for the charts, it goes from the weekly, right, down to the daily and the 4 hours. So for the weekly time frame, right, this is when we use it to help us to identify the general direction of the market, right? Is it going upwards, right? So is it trending upwards, right, where prices are basically forming higher highs and higher lows, or if it's trending downwards, okay? If it's pushing to form lower lows and lower highs, right, the market is generally in a downtrend, right? So if you're taking a swing trade, right, potential positions you want to consider would be taking a short position. Okay, so this is for the weekly time frame. So weekly time frame gives us a general direction of where the market is heading towards, right? It also helps us to identify potential take profit targets. So for example, right, if we have a case where, right, prices are holding above, very nicely above the trend line, right, we can, for example, use Fibonacci retracement, which I will share more in detail later, basically using Fibonacci retracement to help us to find our take profit target. Okay, so one of the take profit targets that's very popular and what I find personally extremely useful is the -27. Okay, so for this, right, we will again hop on to real life examples where I will show you guys later on as well. Okay, so that is for the weekly time frame, and then after that we will go down to the daily time frame. So as much as possible in an ideal situation, right, the weekly, the daily, and the 4 hours time frame is aligned, right? It gives us a clear picture. But of course, that is the ideal situation. There are also cases where, you know, the weekly time frame is showing you a certain direction, but the daily time frame might not certainly agree with that. Okay, so that's something that we have to juggle with as well. So on the daily time frame, right, this is when we try to find, right, try to narrow down, okay, to see if there are any potential setups in the within a specific period. Okay, so within that, let's say a focus, right. So for example, if the chart is not like that, maybe on the daily time frame, after we have identified the general trend, on the daily time frame, we want to focus on a specific portion of the chart that is relevant or with respect to where current prices are. Okay, so that's in the daily time frame, because there is no point if I identify a support level that is extremely far from where prices are, because that would mean that, right, prices, number one, might not ever reach that level. okay? And number two, right, we'll have to wait for a long time for the trade to play out. Okay, so that's on the daily time frame, and then we will go down to the 4 hours time frame. So generally, the 4 hours time frame are very useful, right, in helping us to identify entries. Okay, so you can think of it like when you have pretty much an idea of where the market is heading towards, right, on the weekly time frame, a daily time frame, right, we want to use the 4 hours to try to refine our entries, take profit, and even stop loss levels. Okay, so the 4 hours time frame can be very useful in such cases, and also it helps us to identify market structure, right? So if on the 4 hours, right, we have a very nice ascending trend line that prices are holding above, or even if prices in terms of market structure, they are pushing to form higher lows and higher highs, right? This gives us confirmation that on the 4 hours, right, prices are pushing higher. We want to wait for a pullback, right, before entering the trade. So on the swing trading style, you can see that it's slightly more medium term. In terms of the holding periods, we are talking about anywhere between days to weeks, right? It can last for a couple of days. And then for longer term trades, or rather trades that play out, right, over bigger, larger time frame, right, this can last up to weeks. Okay, so the number of trades that we have per week on swing trading, right, usually it's between 3 to 4 trades. Okay, and then we have day trading as well. So day trading, my colleague Isaac covered in the previous session, right? So for day trading, usually, right, as the name suggests, is within the day. Okay, so we're looking at relatively short-term trades. So ideally, right, I open the position in the day, right, and I close it before the day ends. Okay, so that's for day trading, right? So the charts that we look at for day trading, right, usually it's more of 20 minutes chart, 1 hour, and 4 hours chart, right? If you want to be slightly more precise, you can even try the 15 minutes time frame as well. Okay, so that's on day trading. So 15 minutes time frame can be very useful in helping us to, again, refine the entries. Okay, so holding period, as the name suggests on day trading, usually it's about a day. Okay, so given that the frequency of the trades, right, they are slightly higher because we are looking at shorter term time frame, which means that prices in this smaller time frames are slightly more volatile, right? The movements are bigger as compared to if you put the whole chart onto, let's say, a weekly time frame. So in such cases, it presents us more opportunities. Okay, so usually the number of trades that we have would be anywhere between 5 to 10 trades for the week. Okay, so on average, it is about 1 to 2 trades per day. Okay, and then we have scalping as well. So scalping is extremely short term, right? So there are two kinds of scalping, right? Then one of them, right? So the one that I did. So previously, I also did pretty intensive scalping trades, right? Mainly using Fibonacci retracement confluence, right? So where basically I use Fibonacci retracement and Fibonacci extension, okay, and try to find key levels that line up. So essentially, the idea of scalping is just that you think of it like there is a key support level that we have, and what we're essentially playing is that we are playing that small bounce, right, that we are expecting price to be at a particular key level. So just to put things in perspective, right, for scalping trades, assuming that you identify a key support level, right, on the bigger time frame, let's say on a 1 hour over here, right? So what we're doing is that we are expecting price to push down to this level, right, and bounce a small bounce. So we're basically playing that small number of pips, right? This can range between sometimes between 10 to 20 pips, right? So a lot of it depends on the setup as well. But generally, I would say that for a scalping trade, anywhere between 10 to 15 pips or 10 to 20 pips, right? And you can keep a stop loss that is within that range as well. So this is for scalping trades that are extremely short terms, right? The holding period can be from seconds to 1 hour, right, maximum. So seconds, this really depends on how the setup played out, right? So if there is a key news event, right, and price happen to spike to that key level, right, and take off from there, right, this can easily hit your take profit target within a few seconds. Okay, so that is for scalping trades, right? So the number of trades that we have, it can range between 20 to 30 per week, because on scalping trades, right, these setups are essentially on the smaller time frame. So prices are there's much more movement on the shorter time frame. So because of this movement, it presents more opportunities as well. So this is on scalping trade. Now, the danger of scalping trade is that because prices are extremely volatile, right? So as much as possible on scalping trades, we don't want huge movements coming about. So for example, right, if price is trading within this range, right, and we want to look to long, right, or look to buy once price reaches the key support level and play that small bounce, or even take a short position when price reverse off a key resistance level. So in such cases, right, what would be a nightmare, right, for scalpers is that if there is a key news event coming up, or even, for example, unexpected events, right, which causes prices to swing wildly. So this is something that is going to hurt, because for scalping trades generally, right, we are taking shorter term take profit targets. So take profit targets are generally tighter. And same thing for the stop losses, right, because we're playing a small bounce. So it doesn't make sense for the stop loss to be extremely far, right? So usually stop losses are tight as well, which means that if there are wild volatile swings, right, it means that the stop losses can be taken out easily as well. Okay, so that's something for scalping. So for scalping trades, right, what we want to be careful of is key economic calendar, right, or key economic releases that are coming up. So in such events, right, maybe we want to refrain either from taking the trade or consider factoring in the volatility as we take these trades. Okay, so that's for scalping trades. If we have time, right, I can show a few examples on scalping trades. But for today, you can see that mainly our focus would be on swing trading, right, and how we can basically combine these key levels, Fibonacci retracements, to try and to basically have a good trading strategy. Okay, yeah. So these are the various type of trading styles that we have. Okay, okay. So hello to you, Peter. Okay. Okay, so the next one that we are looking at, right? So for swing trader, right, these are the three points, right? Mainly on swing trading, right? So as what we have mentioned previously, so for swing trading, mainly we are looking at longer term setups. Okay, so holding period usually lasts from a few days to a few weeks. Okay, so I'll give an example of a swing trading strategy that we recently took. Okay, I'll show you guys. So it's actually on dollar CAD, right? And then at the same time, right, swing trading strategy, because by itself, right, it's largely technical. So it focuses mainly on technical analysis, using key levels, right, identifying key levels and playing, right, either the bounce of the key support level or the reversal. Okay, so at the same time, we will also be discussing on the technical analysis related strategies. So a lot of these strategies that I'll be sharing for today, right, involves key levels and also Fibonacci retracements. Okay, so the idea behind swing trading, essentially, it's, so you think of it like this, right? So now that we've identified the general direction of the trend and where price is heading towards, so for example, an uptrend, right, a long-term trend where prices are basically forming higher lows and higher highs. In such examples, right, basically what we're trying to do is that we're trying to wait for pullback, right, before playing in the direction of the trend. Okay, so this is what we mean by capturing a chunk of the price movement, right, in the direction of the trend. As much as possible in swing trading, right, as what we always have, the trend is your friend. Okay, so we try as much as possible to trade in the direction of the trend. Okay, so Fibonacci retracements, personally, I find them extremely useful in helping us to identify key reversal points. Okay, another thing that I do look at a lot as well, it's market structure, right? So if you look at the highs and the lows, right, if prices are pushing to form your higher highs and higher lows, right, we know that price is in an uptrend, right? So that's when we want to consider taking positions, right, in the direction of the trend, so long, right, so buying instead of selling. Okay, so this is the general idea behind swing trading. Okay, so what are the pros and cons of swing trading, right? As with any other style that we have, right? So for swing trader, mainly, right, the first and foremost, right, so I come from both the background of swing trading as well as scalping. Okay, so swing trading, one thing about it is that is a lot less commitment, right, in terms of the time that we have, right? So essentially what we do is that we identify the opportunities, right? So we do the analysis up from the larger time frame, so usually down from the weekly and then to the daily and the 4 hours. So in such cases, this analysis, right, because they are presented on a much bigger time frame, they don't change as much, right, as compared to, for example, scalping trades. So on scalping trades, because this analysis are usually presented on a smaller time frame, so let's say the 15 minutes, the 30 minutes, right? So while it presents a lot more opportunities, right, in terms of taking the trades, at the same time, right, because these are all on the shorter time frame, right, this analysis can change quickly. Okay, so you will have to keep more up to date, right, in terms of the charts if it's on a smaller time frame, just to see if there are any key levels that price broke, right, which might change the analysis. Okay, so one thing about swing trading is that when you do your analysis on the bigger time frame, this is when you have less commitment, okay, because a lot of these trades that you take, right, on these bigger time frames, they don't change as much, so you don't have to constantly look at the analysis maybe every 30 minutes, okay, because a huge number of time, right, this trades, or rather this analysis are presented on the bigger time frame. So this is when we don't have to spend so much time on the charts. Okay, so this is one, right? So it takes time to work out as well. So for example, if you're on a 4 hours time frame and a lot of these charts are presented on the bigger time frame, right? So what happens is that if you do wait for pullback for price to reach this level, okay, this would take some time to play out. Okay, so one example on this again is on dollar CAD. So if you look at dollar CAD on the chart, you can see that previously for I think the past 2 weeks, right, we have been looking at a lot of consolidation on dollar CAD, right, and only after I think in previous week, right, or this week, that was when we saw the real move take place. Okay, so it also captured the bulk of the swing market, right? So on over here, so when the market trends or when price really move, right, and you're in a swing trade and you're in the direction of the trend, that is when prices can really move in your favor. Okay, and because of the characteristics of swing trading, right, and us basically waiting for the setup to play out, it gives us a very higher risk to reward ratio. Okay, so that's for swing trading. We can also trade in the direction of the trend. Okay, so that's also very important for a swing trader. So as much as possible, we want to again capture the bulk of the movement, which is why it is important that we trade with respect to where prices are heading towards. Okay, so the general direction of the trend. Now you might ask, so how exactly do I tell the general direction of the trend, right? So the most basic, or rather just a brief introduction of how it is like, right? You can go onto the chart, right, and just look for prices. If you're not familiar, or rather candlesticks can be confusing at times, you can switch to close, right? So basically switch. Okay, so switch the charts to line charts instead, right? So look at the closing prices and just identify the lows and the highs. Okay, in a clear market structure, prices generally push to form higher lows and higher highs, right, in an uptrend. Whereas in a downtrend, right, so in this case, right, over here, in the downtrend, right, it's the opposite, okay? But prices are generally pushing to form your lower lows and lower highs. In an unclear market structure where prices are generally trading sideways in a ranging market, right, this is when you can see whipsaws around, right? It holds within this range, okay? There isn't a clear market structure. So this is when, in this example that we have first highlighted, right, markets are basically trending over here. Whereas in the example that we have, right, it is ranging sideways, okay, so it's trading sideways, it's moving sideways, okay. So the final thing about swing trading, right, the good, basically the advantage of swing trading is that it is relatively simple. Okay, so it is relatively simple. Okay, thanks, Peter. I got your feedback. Okay, so I will talk a little bit slower. Okay, so it's relatively simple. It can be done with just a computer and conventional trading tools, right? So this is slightly different because when we talk about scalping, right, or even high frequency trading, right, essentially what happens is that, right, we need slightly more sophisticated tools, right, especially if you do high frequency trading, right, we're competing with the institutions, the bigger players, right. That is when you need to be extremely tight in terms of fulfilling the orders and also making sure that the spreads are tight. Because for scalping, right, essentially the idea of scalping is identifying a key level and playing a small bounce. So this is when, right, the spreads would actually take up a chunk of the profits as well. Okay, which is why it's important that spreads are tight, especially if we're doing scalping trades. Okay, so that is the pros of swing trading. Okay, and then of course, right, we have the cons of swing trading as well. Okay, so for the cons of swing trading, right, the first one, right, so given that swing trading, they are usually played out on a bigger time frame, right, so basically what happens in swing trading is that we are holding on to the position for a much larger, longer period of time as compared to maybe scalping trades and even day trading. Okay, so sometimes it can last a few days and even weeks. So in such examples, right, of course, we have our swaps, right, our commissions, right, the holding costs, okay, because holding them overnight and over the weekend, right, it also exposes us to, number one, right, higher holding costs, and number two, right, also market risk as well. Because when we hold over the weekends, right, we don't know what might happen, right, if there is a key fundamental driver that changes the outlook of the currency, right, that would hurt our positions potentially. Okay, so one example is, for example, if you look at CAD, right? So CAD and oil, they are very positively correlated. They generally move in the same direction. So when oil prices or when investors are confident of the market, right, the market outlook is positive and oil prices push up, right, it will positively impact the CAD as well. But there are also cases, right? For example, I think last year when we witnessed that there were few OPEC meetings, right, over the weekends, or the sudden attack, right, for example, on oil supplies, right? There's a disruption for oil supplies. That is when, right, we might see a gap in prices. Okay, relatively speaking, you don't really see gaps. They are more common in stock markets, right? Because there is a certain timing where the exchanges close, but not so much for the FX market because it's generally liquid. Okay, and it's 24 hours, right? It's open 24 hours. So in the FX markets, we do not usually see gaps. Okay, so in rare cases, we do see them, right? Especially if it is driven by a fundamental or key news event. Okay, so that's on holding costs, right? On market risk as well, right? So trading costs can easily add up, but of course, on the flip side, right? If you get in the direction of the trend, right, and you hold this, right? So for example, right, on dollar CAD, you can see that the playing in the trend, right, going in your favor can also rake up a pretty good amount of profits. Okay, so also another thing on swing trading is that it does take time for us to play out. Okay, so maybe for example, right, this setup, right, consolidation would take a while, maybe 2 weeks, right, of holding before it actually trends in the direction. So swing trading, relatively speaking, as compared to scalpers, right, or scalping, you need a lot more patience for the trade to play out. Whereas for scalping, right, usually the trade lasts anywhere within the day, right, even sometimes less than an hour, right, when it reaches your take profit target. Okay, so that's for the main difference, right, between swing trading as well as other styles of trading. It also requires a higher initial capital, okay, because the frequency of the trades are much lesser, okay, a lot of holding time as well, okay, and also susceptible to market whipsaws. Okay, so this one doesn't really apply mainly on swing trading, right? It happens across the board, right? So it can be on news releases, on fundamental changes, right, in the market. So in such cases, right, it can actually hurt other position traders as well. Okay, maybe not so much position traders because they are much longer term. They're looking at a much longer term picture. But for scalpers, day traders, and swing traders, right, if there's a key news event and wild swings, right, this can actually impact all the styles of trading. And also, okay, so a lot of this market whipsaws is also dependent on the stop loss placement. Okay, so if the stop loss placement is slightly further, so if you look at market structure, right, it shouldn't have a huge impact on swing traders. Okay. Okay, so I have a question by Jim. You mentioned about holding costs. If you buying the stock and holding 1 week, do you recommend for CFDs? Okay, so yes, CFDs generally, right, you play the difference between the movement and price, right? But of course, with leverage, right, we have to be slightly more careful as well. Okay, so so that's the cons of swing trading. Now, this is the exciting part, right? So the next part that we'll be exploring is the strategies that we have for swing trading. Okay, so for the strategies for swing trading, right, what we'll be looking at, right, so just to share a bit more on what I personally do. So for swing trading, right, the first thing I want to look at is the market structure. Okay, so I want to identify as much as possible key support and resistance levels that we have over there, and if prices are actually sitting on these key levels, because this sitting on these key levels gives us an idea of where price might potentially be heading towards. Of course, with all other strategies, right, it's not 100% accurate. Okay, we always have to factor in the flip side where the trade goes against us. Okay, of course, if it's in our favor, right, it is good for us, right? But if it's not, right, we want to make sure that trade management and risk management wise, we are actually consistent. So that is our market structure, identifying key support and resistance levels, okay, and also combining them with trend lines as well. Okay, so of course, not trading them alone, but rather combining all these factors. Okay, and the last one that I use a lot as well, it's Fibonacci retracements. So Fibonacci retracements, I will also share, right, when we hop onto the chart later on. Key levels that I look at, we will also do a little bit of back test, okay, just to see how it plays out and how we can use these key retracement levels to combine them for our strategies. Okay, so let me hop onto the charts, right, and we'll see. So for market structure, basically, right, just to share a bit more first on market structure before we hop onto the chart over here. Okay, so for market structure, there are a few key points that I'm looking out for market structure over here. So mainly, right, the general idea is that when we look at it, right, there are two ways, right, so market trading sideways, right? So this is an arranging market, and then markets pushing higher and higher. So whether it's trending upwards or downwards. Okay, so for market structure, right, when we want to identify the key support and resistance levels, right, there are three main support that I'm looking out for. The first support level that we have is what I would call the swing low support. So essentially, prices are pushing, right, and it has tested this level maybe once or even twice as a low. Okay, so this is an example of a swing low. Another example that we have is what I would call a pullback support. Okay, so the term is not that important, but rather the idea behind what this support levels are like. So essentially, right, a pullback support, right, or this second type of support level that we're exploring, right, is actually this support level where price has been tested previously as a resistance before. Okay, the reason why it is important is because, right, at this point in time, right, think of it from a psychological perspective, right? So at this point in time, when price tests this level as a resistance, right, generally what people would do when it sees it come back to test as a resistance is that they will sell these positions, right? So they will take a short, for example. So when you're selling this, it can be a currency or stock, for example, right? When you sell this level and price broke out of this key resistance level, right? What people are generally doing is that they're waiting for price to pull back, where they will then close out the position, right? Because now the trade is going against them, right? It's against what they are expecting. So when price do pull back to the level that they sold at, right, which is this resistance level, they tend to close the position. So this is useful because it helps us to identify this key support levels, right, where it has previously been respected as a resistance, right? It can be once, twice, right, or even more times. Okay, so at this levels when they pull back, right, generally we could see a bounce here. So this is the second type of support level that we have. And the final type of support level that we have is what we will call an overlap, which basically just means that price has tested this level both as a resistance level and a support level. Okay, it has tested these levels before, okay, both as the support and resistance. So if you draw a straight line across, right, how do we identify the difference between the first type and the second type of support level that we have? Is that the second type of support level that we have has not been tested as a support yet, okay, whereas for the third kind of support level, right, we actually saw the bounce above this level. Okay, so this is for support. Okay, so I'm going to hop onto the chart right now and let's see. So okay, so for example, right, given the structure that we've identified previously, right, this is a good example. So over here, so you can see this level, right, just now when I was talking about it as a resistance. So this, I'm currently on a 4 hours time frame. So this is on dollar yen, the chart is on dollar yen. So essentially, when you look at this level, you can see here, just looking at the general structure of the market, this resistance level that we have, you can see this resistance level here. Okay, let me just okay, let me just reload this chart, right? Because I can't seem to make any annotations on them. Okay, but essentially, right over here, you can see these levels. Okay, so here, right, this is on a 4 hours time frame, so you can see very clearly over here, this is the structure. Right, so just playing out, right, you can see at this level over here, right, so price pushed up, respected this level as a resistance, right, but at this point in time, there was a small push, right, so if you zoom in onto the chart, you can see, right, over here, oops, okay, so if I zoom in onto the chart, you can see at this level, there was a small reversal over here, but following that, there was a very strong break above this level. Now, what happens is that once price reaches this level, you can see a strong rejection here, right? And it's partly attributed to the fact that, right, apart from it sitting on the ascending trend line that we have sellers here, right, selling because this was a previous resistance level. But when price actually shot above the level, right, and if they're still holding on to the position, they want to look to close out their trade here, which is the reason why, right, these levels, right, in general, they are very useful in helping us to identify key resistance and support levels. Okay, another example that we have, so this is an example of what we will call an overlap, right? So price tested as both the bottom, it comes from the bottom, tested as a resistance, and tested as a top, at the top as the support as well. Okay, so this is one example. Okay, another example that we have, so the lows that I was talking about, right? You can see over here. So this one, right, we can see that basically price pushed down and there was a strong rejection below this level over here. Okay, so these are examples of lows. Okay, but we have to be slightly more careful because if you notice, right, essentially what happens with this low. So this is another example as well. Let me just zoom in here. So you can see in this example, right, when we talk about the structure of the market here, at this low, you can see at this point, right, just draw this out. So essentially what is happening over here, right, we saw a consolidation where price pushed. Over here, you can see that price tested the low multiple times. Okay, so this is what we call a swing low. So essentially, it tested this levels multiple times, bounced off this level. Now we have to be slightly more careful because in such events, right, there are cases of what we will call a stop hunt. So prices are still moving in the direction, right, still pushing higher. But we could see a push down, right, basically to take out the stop losses before continuing in the direction. Okay, so when you look at swing low support, right, we must always factor in, right, there's a chance that price could spike slightly lower than this level. And the idea behind this is because simply at this levels, right, if you have traders that are just trading purely based on graphical levels, this is the level that they will enter, right? They will enter a long position or they will buy into this, right? So usually when that happens, right, stop losses are put slightly below this key levels, which is why, right, at these key levels, it's important that we factor in this spike as well. Okay, so that is on the first example that we have. Okay, so you can see that in this example, it actually works in the same way, right, if we are looking at resistance levels as well. So for resistance levels, it's the opposite, right? So if we talk about market structure for resistance, right, we are looking at a reversal. So this is what we'll call a high. Okay, so price tested the resistance level and it reversed below this level. Examples of this, right, would be this example that we can see over here. You can see this high, right? So basically, right, price tested this level multiple times, right? You can see tested as a resistance where people try to sell. Now, this is a very interesting example, right? So this actually ties in with what I was saying just now, where basically, right, if you identify a key level, we need to be careful of this stop hunt setups, right? So this is important, right? And we can actually use the Fibonacci retracement to help us to find these levels. So essentially, at these key levels, right, what happened over here is that price pushed slightly higher than this high, right, that has been respected twice over here before pushing down, right? So it actually trends, right? The real move actually starts after taking out a majority of the stop losses over here, right? Over here. So when people see this resistance, right, they try to sell over here, try to sell again here, and once it reaches this level, right, what happens is that it spikes slightly higher. So this is where Fibonacci extensions and Fibonacci retracements will come in. Okay, so for Fibonacci retracement, right, just over here. So at this level, right, so just to give a brief overview of Fibonacci retracements. So essentially, right, Fibonacci retracements, if we want to try to find support levels, we would start from a low. Okay, so you try to identify a movement in the market, and we will start from a low to a high. Okay, to try and draw Fibonacci retracement, we start from a low to a high. If we want to find resistance, it's the other way around. Okay, so if we want to try to find Fibonacci retracement for resistance, we want to identify a movement from a high to a low. Okay, so let's try with this example. You can see over here the high to the low. Okay, so this is the most direct movement that we have, right? Over here. So high to low, right? So I take a Fibonacci retracement of the move. High to low. Okay, so these are the key levels that I use on Fibonacci retracement. Let me just take this up. So Fibonacci retracement from high to low, you can see these levels. So a lot of these levels that I use, right, it revolves around 61.8 retracement, 78.6 retracement, 127. Okay, so 127 is very useful, especially if the 78.6 is broken. Generally, the next level that it goes to is the 127. Okay, and also negative 27 as our take profit target, and the final level value that I look at is also negative 68. Okay, so these are the key levels that I used over here. So you can see in this example very neatly here, right? So basically what happens is that price spiked to the 127. Okay, so if you're considering taking a position like that, over here you can see this high, right? What we want to be careful is that our stop loss, right, ideally should be above the 127 retracement. Okay, it saves us a lot of pain, right? In this case, especially when the trade actually plays out in your favor. Okay, you can see an example in Go as well, right? So Go, let me just look Go over here. Okay, so now that we have pretty much explored Fibonacci retracement, right? So on Go, it's interesting, right? Let's go on to, let me just zoom in. Okay, so on Go over here, you can see when you take a Fibonacci retracement of the move, right? So if you pan out the move, it's down, up, down, up, down, up. Okay, so over here, right, this move, when you take a Fibonacci retracement from the high to low, right? So just now when I introduced the Fibonacci retracement, I showed these key levels, right? Negative 27 and negative 68, I want to change them into a different color. And this is important because these levels, right, are extremely useful as take profit targets. Okay, Jen, I use negative 68, but if you want to be slightly more conservative, you can also use negative 0.618. Okay, so this is more personal preference, right? If you want to be more conservative, you can use negative 0.618 as well. Okay, so that's fine. Okay, so but personally, right, I use negative 68 slightly more. Okay, but you can always use it interchangeably, right? Negative 0.618 would get us out of the trade slightly earlier. Okay, so that would be better if you are more conservative. Okay, so in this example, right, negative 68 and negative 27 are useful for take profit targets. Okay, so you can see in this example, so for example here on Go, high to low, right, if you take a retracement of this move over here, you can see price pushed right near the negative 27, and along with that, right, it was the graphical level as well, right? So combining what we learned previously, you can see this level over here, where price basically there was a strong push up, right? Tested this level as a low before pushing higher. Okay, so this is something that we want to be careful of as well, right? So on negative 27, and even so much on the monthly time frame, right, it gives us a clearer picture. So on the monthly time frame, right, on Go, at this bounce, right, over here, you can see at this level, right, if you take a retracement of the move, retracement from high to low, right, because if you pan out the move, you can see that it goes down, up, down, right? So over here, so again, I take a Fibonacci retracement from high to low over here. Now, this is interesting because what happened basically, you can see over here, is that price push. So I'm on the monthly time frame, price push down, tested this 61.8 that we have over here, right? And it pushes down to the negative 27 as the target. You can see at this level, right? Over here. Okay, so this example doesn't apply just to Go, right? It goes across other pairs, right? It can be dollar yen, dollar cat, which I'll show as an example later on as well. But essentially, you can see over here, right, where we saw the reaction of the negative 27, and this is on a monthly time frame, so it's gonna take a while to play out. Okay, on the daily time frame, you can see a double bottom being played out as well over here. Okay, so this is what we see on Go, right? So essentially, right, the point for this is basically to show you guys that negative 27 can be useful, right, if you're trying to use Fibonacci retracements to identify your take profit targets. Okay, so not only just on Go, right, we actually have examples. You can see the same thing happen on dollar yen as well. Okay, so you can see on dollar yen over here, right, in this example. So the first thing we want to note, right, when we're using Fibonacci retracement is that we want to try to find the trend. So you can see on dollar yen over here, right, prices are in a downtrend. It's pushing, right, to form lower lows and lower highs. Okay, so if candles and the whipsaws are slightly confusing, you can just go on to the close, right? In close, you can see as well. If you draw out the highs, right, you can see this highs. Let me just change the color so that it's slightly clearer. But essentially, at this highs, you can see this highs over here. Right, prices are pushing to form lower lows and lower highs. You can see, look at when you draw the lows and the highs, right, in close, you can see that it's clear over here, right? So the change in trend comes, right, when price actually broke the previous high as well as the trend line. Okay, but this is what basically over here you can see here, right? In this downtrend, same thing. We want to try and find our move. Okay, so when you pan out the movement that we have, right, it goes here, down. Oops, sorry. Okay, so when you pan out the movement here, okay, down, up, down, up, down. Okay, so basically, yeah, so you can see the movement over here. So basically what I want to do, right, again, take off Fibonacci retracement. You take off Fibonacci retracement from the high to the low. Okay, so when we do that, retracement from high to low, right, what we are looking at over here is that you see price actually reacted. So we took a retracement here. So price actually pushed up to the descending trend line as well as the 78.6 retracement, following which, right, it actually pushed lower, and the first target that we have is the negative 27 here. So you can see at this point, right, over here, so price held out at the negative 27. You can see a double bottom being formed in close as well over here. Okay, so the double bottom, let me just over here, you can see this push, this double bottom. Okay, but what's more interesting is that in line with this retracement level, right, the confirmation for the bullish move comes, right, when the trend line is broken. Okay, but this is basically how we can use Fibonacci retracement, right, combine them with the analysis and essentially use them, right, to give us clue as to whether we could be potentially seeing a reversal in trend. Okay, so this is on dollar CAD. You can see the same example on pound QE. Okay, so on pound QE, right, this is interesting on the weekly time frame. You can see as well over here, right, so downtrend. Okay, so downtrend, look at where prices, so prices pushed down, tested the trend line again, right, so this is the move. So I will take a retracement again from the high to the low. Okay, so the high would be my starting point, right, where I'll be starting the retracement, and this low is the ending point. So let's try and find, right, if there are any levels that line up here. Okay, so when I do that, right, Fibonacci retracement of the move. So this is the downtrend that we have. Let me just bring this up. Okay, so you can see this is the downtrend that we have over here. So when you do a retracement of the move, Fibonacci retracement from high to low, right, you can see again what's interesting over here. Okay, so when you do a retracement from high to low, price again spiked to the 61.8, right, and it reaches the negative 27 over here before pushing high. Okay, so negative 27 can be pretty useful as take profit targets. That's one. It can also be useful in helping us to identify key levels, right, for potential reversals. Okay, so that's on pound QE. Right now, let's zoom in onto the chart and try and find if there are any setups. Okay, so far the setups that I've showed you guys, right, it's mainly on resistance. Okay, so basically trying to play that drop, right, to negative 27. Now let's try and see if the same thing actually applies, right, if we are taking a long position. Okay, so on pound QE, right, you can see the same example over here, right, ascending trend line. Okay, so focus on this portion of the chart, right? So essentially over here, you can see the same thing happen again. And you take a Fibonacci retracement. So Fibonacci retracement of the move from low to high, this move down, this move up, right? So when I take a retracement of the move from low to high, right, over here. So, oops. Okay, so low to high, right? Again, you can see what happened. Okay, so this move, it's very clear. So over here, right, price pushed to the 61.8 retracement that we have. It pushed to the 61.8, and then following that, you can see that it pushes to the negative 27 over here, which is this take profit target that we have. It's the first take profit target. Following that, we saw a pullback. Okay, so of course, once this happens, right, we have to rely on the second factor we have, which is our trend line. Okay, so trend is your friend, so it's important that when we look at the setups, right, we want to make sure that we don't play beyond a key level as well as the trend line. Okay, so price pullback tested this level. You can see that it tested the trend line, and if you do again the retracement of the move, so let me just remove these markings over here. Okay, so when you do a retracement of the move again over here, so now, right, get on the pullback, Fibonacci retracement from low to high here, right, because this is the move, right, so I'm going to start from this point and I am going to end at this point. So when I do that, right, low to high, okay, now this is interesting because once again, right, we can see price tested, so the two levels we watch out for. In this case, you can see that the 78.6 retracement over here lines up more nicely with the trend line. But what is again interesting is that price pushed up, right? We have two targets. The first target is the negative 27, which we saw that there was a strong bullish candle, a push above, and the second target that we have is the negative 68, right? Or negative 61.8, right? If you guys rather use that, because that is the key retracement level. So at this point, you can see, right, it pushed to the negative 68 before the reversal. Okay, so the main point of showing you guys this is because I personally find that on Fibonacci retracements, these key levels are useful, which is why, right, I thought that it would be interesting to share this in the session as well. Okay, so this is part of what I use, right, when we're using basically for our swing trading strategy. Okay, so the last example I actually want to show you guys where this retracement workout is on dollar CAD. Okay, so on dollar CAD, right, you are pretty much seeing the same thing. Okay, this is clearer on the weekly time frame. So this method applies across different time frames. Okay, it doesn't necessarily have to be specifically on the weekly or the monthly time frame. It goes across from the 4 hours to the 1 hour as well. Okay, and even beyond that, 15 minutes works too. Okay, so basically, in this idea, you can see on dollar CAD on the weekly time frame. Over here, you can see prices are pushing, right, to form this descending trend line, right? Basically, the trend on dollar CAD, right, it's downwards, right? And why would we say that? It's because you can see that, look at the lows and the highs, right? If you switch it to close, you can see that in terms of the lows and the highs, prices are generally, you can see this level, right? So the highs over here, look at the highs and you look at the lows, right? It's pushing to form lower lows and lower highs, right? If you pan out the move for highs and lows, you can see over here. But what is interesting is that when you go on the weekly time frame, right, if you take the move over here, right, so if I take a Fibonacci retracement of the move here, right, so Fibonacci retracement from high to low, this move, you can see it pulls back. So when I take a retracement of the move from high to low here, now this is interesting because if you zoom in into this portion of the chart, right, essentially what we're looking at, right, is that price, so pan out the move, price push down. Okay, so price push down over here. It tested the 78.6 retracement, right? And it pushed straight to the negative 27, right? And following this, we saw this green candle, right? This green candle over here, okay, where there was a big pullback. Okay, so on the daily time frame will probably be clearer, right? Basically, this pullback over here. Okay, and it happens because price tapped the negative 27 before pulling back. So same thing, right? On the weekly time frame, following the pullback, we want to again do a retracement of the move. Okay, so following this retracement of the move, right, you do the same retracement from high to low. Okay, so Fibonacci retracement from high to low, right, and what we notice again, right, in this example, right, you can see here, so this move, right, so price again pushed up to the 61.8 and it tapped the negative 27 here. Okay, so it pushed down to tap the negative 27 before we once again witness a pullback. Okay, can you see this pattern that's playing out? Okay, so it's still holding with the trend line. You can see that the downtrend line is still intact. Prices are still pushing to form lower lows and lower highs. So once again, we want to repeat the analysis. So now we take it on the last move. So again, you do the Fibonacci retracement on the move Fibonacci retracement of this move, right, from high to low. So when you do that, right, high to low here. Okay, so what we have noticed again, right, in this move is that price again pushed to the 61.8 retracement, right? And following that, we know that negative 27 is the target. So on dollar CAD, right, we know that there is at least room for more downside over here. Okay, so this is the bigger picture. Okay, so you have saw how in the previous examples as well, right? Price pushed down, tested the negative 27 before pulling back up on the bigger time frame. Okay, so at this point in time, okay, you can see over here, right? So there is basically limited room for more downside before price reaches this first level. Now, that's not to say that when price reaches negative 27, we go for an immediate long position, but rather because we need to keep in mind that the bigger time frame is still bearish for us, right? So it's still pushing to form lower lows and lower highs. So what we are waiting for is that when price reaches level, right, there is either a break of the previous high, right, for the pullback to the bigger time frame trend line, right? So this is one, or price breaks below this level to continue pushing down to the negative 68. Okay, so when we are doing swing trading as much as possible, we want to try to trade in the direction of the trend. Okay, so that's on dollar CAD, right? We have let's see. Okay, and then on dollar franc as well, right? You actually see the same example. Okay, I have a question by IP. Why did you pick the March high and not an earlier high in October, November? Okay, so are you referring to what time frame are you referring to? Okay, are you referring to the current time frame that I'm on, which is the daily? Or are you the current chart. So okay, so the March high. So let's see. Okay, so you're saying that why did I pick this high, right? Okay, so IP's question is that why am I picking this level, right, this high, instead of this high over here? Okay, so the reason I'm picking this high is because I'm trying to find a reaction that price react off the 78.6 and 61.8. When you combine these levels with a trend line, right, as we saw in the earlier examples, right, we know that we can have negative 27 as the take profit target. Just look at the same example over here, right? You see this trend line that we have. Okay, so in this example as well, right, when you do the retracement from high to low, you can see, right, essentially what I'm looking out for is that a reaction, right? So price reacted at this level or this area that we have over here, and the first immediate push down is to the negative 27 that we have, right? Following this reaction, you can see this immediate push down, right, to negative 27 before price reacts here. Now, the same thing happened again, right, when we put this analysis or this Fibonacci retracements across. So the last move that we currently have, you can see the last move that we have over here is actually this move, right? So the high to the low, right? So what I'm trying to check is that if price reacts off the 61 or 78.6, and if that happens, right, potentially negative 27 could be the take profit target, which is why, right, if I'm taking this high, right, what I'm basically saying is that I'm waiting for the pullback, right, to the 61.8 before playing a further drop. Okay, so I hope that's clear, right? So essentially, right, I'm taking this high over here because this is the last move that we have. You can see that if you draw the move down, up, down, up, down, up, this is the last move downwards, right, before pushing higher. So I'm trying to find the target, which is why I'm taking this move. Okay, so you can see over here, right? So this move, right, when you take the retracement high to low, price pushed up to the 61.8. And we know that as with the previous test, right, this would be the first potential target that we have. Okay, so this is why I took the move over here, right, instead of the March high, right? So I took this move, which is the October-November high. Oh, sorry. Okay, so the March high, so the October-November high, which is this October-November high. So this move over here, right, this has happened already because if you look at the weekly time frame, right, the bigger time frame will always show us a clearer picture. So on the weekly time frame, you can see this high, right, this high to low, right? So this move has happened already. Why? Because when you take this move from high to low, you can see in this example, negative 27 has been reached, right? Where has it been reached? It has been reached here. You can see this move. Sorry, I have to off the magnet mode. Hold on. Okay, it has been reached here. You can see this negative 27, right? On taking this move, the move has been completed right before it pulls back. Okay, which is why this high, the move has been done. Okay, which is why I would take the second high because I'm gonna try and project where prices are gonna head towards. Okay, so that's I hope I answer your question, IP. Okay, so that's combining Fibonacci retracement, right? So essentially the last one that we have, right, where we basically use market structure, trend line, and Fibonacci retracement to complete, right? This is an example of how we use it. You can see for an example on dollar yen as well, right? So of course, while Fibonacci retracements, right, personally I look more at the 61.8 and 78.6, but across the board, right, you can see even on dollar yen, right, other retracement levels would line up as well. So on dollar yen, right, there's a very clear example on the weekly time frame. We can see this ascending trend line over here on the weekly. But what's even more interesting is that if you take a Fibonacci retracement of the move, right, you can see over here, price sits on the 50% retracement, sorry, the 38.2%. Okay, price sits on this level, the 38.2% retracement. And if you do another retracement from low to high here, right, what is even more interesting is that we have what we call a Fibonacci confluence. You can see, right? Now I shared that when 78.6 is broken, right, what we have is the 127 as the next level. Okay, so you can see at this level, right, there is a what we call Fibonacci confluence level that line up here, where basically, right, there are a few key retracement levels that line up, okay, to give us confirmation of a further bounce. Okay, so I hope that helps, right, to give a clearer picture as to how we can basically combine Fibonacci retracements as well as extensions, right, and also Fibonacci retracements, and basically how we can use, right, the trend lines and market structure to help us to identify key support and resistance levels. Okay, so do you guys have any other questions? So I have a question by Jim, right? What happens if the trend line in the daily and weekly are shown in different direction? Which one do you choose? Okay, so that's a very interesting question, Jim. So I have a perfect example on this. It's actually on gold, right? So basically, the bigger time frame will always hold more weight. Okay, so in this example, let me just show you guys on gold. Right, so this is interesting because on gold, right, what you see on the monthly time frame, you can see very clearly over here, right, prices are sitting on the negative 27. If you do a retracement from high to low, right, so if you do a retracement from high to low here, prices are sitting on the negative 27. And again, if you do a retracement, let me just remove all of this. Okay, so I'm on the monthly time frame. This is the larger time frame trend line. It's going to hold more weight as compared to the other time frames. Okay, so over here, right? So you can see at this level, there is Fibonacci confluence lining up as well. There is also an ascending trend line over here. So this is on the monthly time frame where we saw the bounce and go. But on the weekly time frame, right, it's getting slightly trickier now. Why? Because you can see here, okay, so monthly time frame, we saw the bounce over here. So if I am on the monthly time frame, so I actually took a trade on gold here, right? When prices are at this level, I took it from the low over here. Okay, so basically what is happening over here is that you can see, right, this is a key support level, right? Why is this a key support level? On the daily and even on the weekly, you can see very clear. Okay, so at this point in time, right, okay, hold on. So this is where we were. Okay, so this is where we were, right, on the monthly time frame, where basically prices are sitting on a key support level. Okay, so basically what we are seeing on the weekly time frame is that we are seeing a potential bounce. Okay, and then on the weekly time frame, you can see as well that it was sitting on a key support level. Why? Because this level, again, you can see, look at how prices react below this level. Right, prices pushed up, respect this level as a resistance, and we saw consolidation here. Right, so prices consolidated, held as a support before pushing higher, and right now it is back to test the support level again. Right, so we know that on the bigger time frame, the monthly is showing you that it's bullish, the weekly is sitting on a key support level, right? But as what you have mentioned just now, on the trend line, right, on the smaller time frame can give conflicting views. So where is the conflicting view in gold? Right, the conflicting view comes over here. It comes in this descending trend line. Gold has yet to break this level, right, which means that it could give us very limited upside. So not to worry, right? So at this point in time, right, what we're looking for is that we're trying to play a move up. Okay, so at this point in time, when I took the trade, my mindset was that I was trying to look. I know that on the monthly time frame, it's bullish for me. I'm trying to play a move up to the weekly resistance level. So I wouldn't play beyond this level. At the same time, right, if I zoom into the smaller picture, it gives me room, right, to play the bullish move, right? Because we are going down onto the smaller picture over here. Okay, you can see this level over here. Okay, so it gives us room to push up, right? To basically play the move up. Okay, so basically to in response to your question, right, the bigger time frame holds more weight, but you can also use the bigger time frame, right, the view that you have on the bigger time frame to try to play to the smaller time frames resistance level. So I actually closed out my position on gold. I closed it out somewhere here, right, because this was a key resistance level for me as well. Over here, you can see this level. Okay, so this was a key resistance level because again, look at how price reacted. Tested as a support before the strong rejection, tested as a support again before the strong rejection. So I closed out the position somewhere here, right? And also keeping in mind that the weekly descending trend line, it is near this level. Okay, so the position that I took was here, somewhere here, right? And the reason for that is because I saw that price actually broke the trend line, it broke the descending trend line, and it was sitting on a key support. And for those of you guys who are familiar with chart patterns, right, this is what I would say. This is a double bottom that we're seeing here. You can see that there was a push down, right? There was a rejection here. And again over here. Okay, so this is the double bottom that we're seeing. Okay, so I hope that answers your question, Jin, right? I have a question by Megan, right? Just double check with you. High to low to find support and low to high to find resistance. Okay, it's the other way around, Megan. Okay, so to find, if you want to draw Fibonacci retracement to find support, is from low to high. Okay, so you start from a low over here and you end at a high. This is to find support. Okay, high to low is to find resistance. Okay, Okay, and another question, right, Megan, is what happens if previous chart highs are from 3 years ago? Can you do a Fibonacci retracement for that long ago effectively? Okay, so personally, I don't focus so much on that because it can be very long. Okay, so what I do is that I would do take a retracement with respect to where current prices are. So as much as possible, right? I try to keep it within where recent prices are. So on a weekly time frame, right, my focus would really be on this portion of the chart. Okay, so unless you're talking about trend line, but if I draw a Fibonacci retracement, as much as possible, I try to keep it within where prices are. Okay, so yeah, so 3 years ago, it's very far off. So for example, on the monthly time frame, right, we're looking at somewhere here. Okay, so you can say that a retracement would be from this move, right? This move to this move. Theoretically, it's not wrong, but as much as possible, try to find a direct movement. So something that would be ideal, right? For example, would be something like that. You can see that this is a very direct movement that we have. Okay, so this Fibonacci retracement is good practice, but if we have price, right, that is ranging around like that, right, you don't want to draw from this low to this high. Essentially, because when I draw this, right, if you focus on the dotted line, right, which is the trend line that you use to draw your Fibonacci retracement, right, prices should as much as possible follow this trend line. So just to give a quick example, you can see this trend line that I drew, right? You can see this trend line. Let me just darken the color. Okay, basically as much as possible, you can see this dotted line that we have over here. We want prices to follow this trend line, okay, and not whipsaw around. So you can see it's like a line of best fit. It acts as much as possible as a line of best fit, but if I apply the same Fibonacci retracement in this example, you can see this portion of the chart is not ideal. Why? Because it basically does not respect the trend line, right? So this portion of the chart is not ideal. So in practice, right, in theory, this is the right retracement to draw, but it's not ideal simply because of this highlighted box. So what would be ideal is this move. You can see this move, right? So I would say that in response to your question, right, not the time frame, but rather look at the movement in price. If it is a smooth one movement up, right, then it makes sense. But if prices whipsaws around this level, right, then you want to try to find the most direct movement. Okay, so yeah, so I hope that answers your question, Megan. Okay, so I think that's about all the time that we have for today, right? I hope you guys enjoyed this session and you find it meaningful and helpful. You're very welcome, Megan. Okay, so the next webinar that we'll be having, right, you can just go to this fpmarkets.com/fr/trading webinars, right? So over here, you can see that there are all the webinars, right, the schedule that we have. You're very welcome, Jim. Okay, so thanks everyone. Thanks, Jen, right? So I hope you guys enjoyed today's session, right? Trade safe. Stay safe as well. Thank you, Nagamani, right? So take care. Thank you, Peter. Okay, so I'll see you guys again next week, right? Trade safe. Take care of yourself. Okay, thank you, David. Okay, and I'll catch you guys again soon. So thank you and goodbye.